found myself reading the Wall Street Journal as a mechanical engineering student and a lot more fascinated with what I was reading there than, my differential equations class. And so ultimately gravitated to the business school and started reading everything I could on investing, but had no idea how to do it right at the outset. I read Plassen's The Richest Man in Babylon. And it dawned on me at that point the beauty of compound interest, and realized that through money you could be independent. I mean, I was always fiercely resolved to be independent. I wanted to be doing what I wasn't doing, and I wanted to be alone, and I wanted to do things my way, and realized, my goodness, if I save a very high percentage of my income, and I compound it well, that's financial independence is not having to work for anybody.
Welcome to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest topic of all, money. How to make it, save it, keep it. But our conversations lead us to an even bigger question: what it means to live a rich life beyond money. My guests share their practices, principles, and evergreen wisdom. I'm your host, Bogumil Baranowski, author, TEDx speaker, and investment advisor to wealth creators with patient capital and an infinite investment horizon. I work with families and individuals who aspire to grow wealth over a lifetime and generations through disciplined, thoughtful investments in durable quality businesses, while giving money meaning. Join me on this quest to unearth and share the wisdom of the ages. Let me share with you the podcast program disclosure statement. Blue Infinitas Capital LLC is a registered investment advisor, and the opinions expressed by the firm's employees and podcast guests on this show are their own and do not reflect the opinions of Blue Infinitas Capital. All the statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. The information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. The information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. None of what you're about to hear is investment advice. All right. My guest today is Christopher Bloomstran. He's the president and chief investment officer of Semper Augustus Investments Group. Chris has 3 decades of professional investment experience with a disciplined, value-driven approach to fundamental equity and industry research. Chris, how are you? So nice to see you.
I'm great. It's terrific to be here. I've been listening to your podcasts, and they're fantastic. It's been fun getting to know you over the last few years in places like Zurich at John's conference, and so glad to be doing this with you.
Oh, I'm delighted. I ran into you in Omaha the last 2 years, and I told you I'd love to have you on the show, and we're making this happen. So you made my day. I was telling you how this was an excuse for me to go back and reread your letters. So they're fresh in my mind, a lot of them, and I have 1,000 questions. And just for the benefit of the audience, Chris writes those incredible letters. They're 100 pages or more each year, and you make them available to the public. Am I right?
They've been available to the public since the 2015 letter, and we've subsequently put a bunch of the older ones on the website. So, yep, they're available.
So anybody curious can explore what Chris was thinking at different points in time. And I went back to the year 2000, which was an interesting time, and I'm sure it will come up in this conversation. Before I ask you about the letters and everything else, I like to start those conversations from the early days, if you allow me. And I ask my guests about their childhood and upbringing and how they think that this time shaped them, their relationship with money, and then the career path that they chose.
Wow. Interesting way to start. I think you heard my discussion with William Green on his Richer Wiser Happier. And I noted that I wrote in my last couple letters that my mom was passing, and she did pass last year. And kind of been a little more open about my formative years. My mother left my biological father when I was 7, remarried at 8, and the guy she married um, was just contemptible. I won't get into the details, but I mean, I very much did not want to be in that setting. I mean, it was a shock to, have a new guy in your life and then to have him be just deplorable. And so I think so I'd already gotten into sports, playing t-ball as a little kid. And I think I was a pretty good athlete. I mean, I don't think they would do t-ball all-star teams anymore, but I don't know what I was, 5 and 6, and was selected to the all-star t-ball team. And so I think what that probably meant was you had just a handful of kids that didn't rush the mound when a ball was hit to the pitcher, to the pitcher's mound. Having coached t-ball in later years and then baseball and football and a bunch of sports, those early years trying to get those little kids focused is they're out there having fun, and you get 1 or 2 or 3 that really are there to compete. And I was already competing, but being in that environment, I just didn't want to be home. And so from the age of 7 to 17, I really immersed myself in sports. And in doing so, came to know a whole series of men, coaches, really, and then teachers at school. But really, it was my coaches, and particularly the football coaches, that became mentors to me and father figures to me and supported me. And I wanted to emulate them and not those that I was living with. And so I was out every single day. If I didn't have a formal practice with a team, whether it was basketball, baseball, football, whatever, I was always across the street. We had an elementary school across the street, and I was throwing baseballs into a chain link fence, shooting baskets, and I would be out for hours and hours and hours. And I'd be out with my friends, but that's all I wanted to do was just sports, dedicated my life to it. And then, sports get more formal. And, by the time I must have been 8th grade, I really found weightlifting, which was terrific. And I fell in love with the gym, ultimately became, won state championships in powerlifting. In college, I played at University of Colorado, so at a pretty high level. I was the strongest player in the Big 8, but there was nobody going to outwork me. And so I was just absolutely driven. I didn't want to be a kid. I mean, when I was a kid, I didn't want to be a kid. I wanted to be out. I wanted to be an adult. And it was a great diversion. And I owe a whole bunch to these men that coached me, because they were just the exact opposite of what I saw. And through the lens of what I saw growing up, I resolved at a point to just live my life differently. I mean, I wasn't going to be immoral. I wanted to be ethical, and said, you're not thinking about having kids when you're a kid, but at a point you say, if I'm going to have a family, I'm going to do this differently, and I'm going to be a good role model. And so, I set out to do that. And oddly, there was one other kid in that environment who, kind of co-opted the behavior that was so deplorable and has lived his life accordingly, which is very unusual because 2 sets of eyes, 1 year apart, seeing the exact same thing. Mm-hmm. One goes one way and the other goes another way. So in any event, I think that was really, I'm not sure I'd be who I know I wouldn't be who I am, and I know I wouldn't do what I'm doing and do it the way I do it, had it not been for that experience. So, I'm thankful at some level for what I had to endure. Because Mario Belli talks about PhDs, not so much in the academic sense, but looking for kids coming out of school that are poor, hungry, and driven. Well, I was very driven by the experience of that 10-year period, and even in high school, last couple of years, really my senior year, was never at home. I was living in my friend's basements, a whole series of friends, and even beyond coaches, there were quite a few of my very good friends' fathers who also became role models, and they were good human beings and really looked out for me. And so I was blessed to have a network of people that put their arm around me and kind of fostered who I became.
It's incredible how those early years can shape you and set you in a certain direction. I'm curious about the money dimension. What was it like? How did you think or feel about it? Was there a lot? Was there little? Were you How would you describe that time?
Interesting. So, uh, I wasn't really, I mean, I don't think as a kid you were aware of money. Warren was at
Mm.
whatever age, 12 or younger. I will say I was a voracious reader. I love numbers. And so, I'd immerse myself in the sports pages and, all of the baseball numbers, especially. Found some books on baseball statistics, which I loved. And at a point, started reading the business page of the local two newspapers, the Rocky Mountain News and the Denver Post. Denver used to be a two-paper town. Um, and so I was kind of monitoring the prices of gold and the Dow Jones and some companies, and I had no idea what the price of IBM meant, but I noted that it went up and down, and that was interesting
Mhm.
to me. And wound up studying engineering initially before I moved to the business school. And at a point, the engineering library had subscription to a bunch of business magazines and the Wall Street Journal. So I found myself reading the Wall Street Journal as a mechanical engineering student and a lot more fascinated with what I was reading there than my differential equations class. And so ultimately gravitated to the business school and started reading everything I could on investing, but um, had no idea how to do it right at the outset. There was no financial statement analysis. I hadn't found security analysis. So I was reading technical analysis books and doing candlestick charting. And William O'Neill with Investors Business Daily had a CAN-SLIM method,
Mhm.
which I think is still a thing. And it was an acronym essentially for momentum. And when you have an earnings per share breakout or a stock price breakout, invariably you're buying things at 52-week highs. And um, I guess in school, I read Clausen's The Richest Man in Babylon. And it dawned on me at that point the beauty of compound interest, and
Mhm.
realized that through money you could be independent. I mean, I was always fiercely resolved to be independent.
Mhm.
I wanted to be doing what I wasn't doing, and I wanted to be alone, and I wanted to do things my way, and realized, my goodness, if I save a very high percentage of my income,
Mhm.
and I compound it well, that's financial independence is not having to work for anybody. And so I got that at a pretty young age, and from there, eventually, the first stock I bought when I was in school, uh, read a heard on the street column in the Wall Street Journal about a very large crude carrier business in Norway. They had four tankers, and um, it was a bad capital structure. They were old vessels. They were going to run them for a few years and then scrap them. And with the proceeds, you'd pay off all the liabilities, and it would all be great. And um, shortly after I bought it with all of my money, I mean, I had summer jobs during college. You couldn't work during the school year because you're on a scholarship and playing NCAA football. But I worked in high school, and I had some money. I had $7,000. I had a little bit of money left over from my scholarship. When I stopped playing football, I had an injury my junior year, which didn't let me play my senior year. But so it was in that senior year that I plunked all my money down on this company called Nortankers, which went bankrupt literally within a month or two of having
Mhm.
purchased it. Um, and kind of said, geez, this is your hobby. You're reading all these books on investing, and realized, well, this is a bad outcome, for something you're so interested in. And but I realized I had never read a financial statement, and so I literally had to write a letter to the headquarters of the company, and during their bankruptcy proceedings, sent me 3 years of annuals or whatever it was, and that was really my first introduction to reading a balance sheet. Because even though I was studying finance at this point in the business school,
Mhm.
it was very academic. I mean,
Mhm.
the efficient market hypothesis was the thing. And
Mhm.
even when you were running DCFs, it was very much not in a company valuation sense, but it was
Right.
a project oriented sense. And so,
Uh-huh.
should a company build a building? Should we spend money on CapEx on this project? And I didn't equate that, the DCF process and all the variables that go into it, to valuing a company. That only came really after I was managing money professionally.
It's fascinating because it rhymes with my experience. So I took all the finance courses, accounting courses, and it wasn't until I picked up One Up on Wall Street by Peter Lynch, where I read that stocks are small pieces of businesses, where it clicked for me. It's not abstract, it's real. I can buy small pieces of businesses, even with a few $100s, or even, if you can afford a single share, you can become an owner just like the founder or whoever controls the business. It just blew my mind, as simple as the idea sounds to me when I say it today. But when I was 20, It just opened a whole new world. At some point, you discovered Charlie and Warren. And I want us to go back down the memory lane a little bit, and you talk about it in your letters. What are some of the most memorable moments that you go back to when you think about the two of them?
Oh boy, there's so many.
Mm-hmm.
I really didn't find Warren and Berkshire until they issued the B shares in 1996. My now business partner he was an auditor with KPMG and then Ernst and Young, both in Dallas and back in Denver. And he said, look, this company's going to do an IPO of these B share classes. Might want to take a look. So Chad and I had gone to school together at Colorado, and we were great friends, and we'd talk every week or two about investing. I'd go down and see him in Dallas. We'd hang out, and really all we ever talked about was stocks. And so I dug into it, was working at a bank trust company in Kansas City. And it was not in the research universe. We didn't have a file on Berkshire Hathaway in the library. My boss said this is really nothing much more than a glorified mutual fund. And as I got into it and read the prospectus and three, I think, of the most recent annuals and the chairman's letters, wow, it just clicked. I realized this is like no chairman's letter that I'd been reading, and I was working, still am, but I was working 80, 90, 100 hours a week, just learning as much as I could about every single company I could get my mind around, and I'd go from one to the next to the next, and I was visiting companies. We had a small cap fund that was Midwestern based, and so we had, I think it was an 8-state region, and I visited every company that was in our research universe, and I was just learning and learning. But then Berkshire comes along, and one of the things that would struck me as highly unusual was the cover page of the proxy for the B share IPO, which had 4 or 5 bullet points that essentially started with, neither the chairman nor the vice chairman, Warren Buffett or Charlie Munger, find the shares sufficiently undervalued where we would recommend purchase to our families. So they did the B shares to ward off a group that was going to essentially, with a unit trust structure, allow people to buy the Berkshire shares at a smaller price point. I don't know what they were trading for. They were probably at that point 20-something thousand per A share. Mm-hmm. Well, at that point, the gift tax threshold was $10,000. So if you wanted to give a share of stock to one of your children, you couldn't do it. There was nothing to convert the A share into, and it was too large of a dollar amount. So conceptually, it made sense. But these guys were going to charge something like a 3% fee. Warren found that reprehensible. And so they issued the shares, and they set the subscription size. They kind of monitored it to demand. And I think one of the most fascinating listens is the annual meeting that following year. I guess it would have been the 97 annual meeting, where Warren said, we're just going to take questions for the first few minutes and just answer questions about the B shares. Now, this thing was already sealed because Warren, the insiders had voting control of the company, and so it really didn't matter what the share vote was going to wind up being on the issuance, and it was 99% approved or whatever it was. But Warren and Charlie took questions for literally an hour about the merits of this thing, and at a point the questions became repetitive. At a point, people were asking, the shareholders who were queued up in the arena trying to ask questions started trying to get in their real questions and not the B share class question. Mm-hmm. And at a point, Charlie kind of whispered over at Warren, and Warren said, well, Charlie just said, couldn't we get this thing on already and get it over with? And everybody laughed, and Warren says, oh, don't humor him, folks. So there was a morality to what they did. And so I instantly sent in to the home office in Omaha. They used to give you the chairman's letters in 3 bound editions, and they didn't charge for them. They'd mail them to you, and they were, I don't know, that thick from 1977 forward. Now they're all on the internet. You've had, several books put together, a bunch of the letters, but, I read those things voraciously. Mm-hmm. I had not read The Intelligent Investor, but, right around that moment when I was doing all the research on the issuance, found The Intelligent Investor and the appendix, The Super Investors of Graham and Doddsville, literally read the book twice over 2 nights. I couldn't put it down. I stayed up all night, essentially, the first night, and did the same thing the next time. That was the light. I mean, I like you found One Up on Wall Street to be a great read, and that was the first
Mm.
conceptualization that these are not prices on a screen, but they reflect what you do your share count and figure out what the market cap is and relate that to the size of the business and what it's worth. And so there's so much. We're just all so fortunate. We lost Charlie, of course,
Mhm.
but we bought Berkshire for the first time in February 2000. The stock had been cut in half after they bought General Reinsurance in 1998 using Berkshire shares as currency when it was trading for almost 3 times book. Coke was a problem because they made
Mhm.
so much money in it that it was 40% of the stock portfolio trading at 50 times earnings.
Mhm.
And so they, give up, 18% of the ownership, but picked up 45% of the combined assets. It was, in my mind, a brilliant transaction. I've written about it a bunch of times in my letters and talked about it on a few podcasts. But the stock got cut in half, and so there in 2000, Chad and I went to the Omaha meeting for the first time, and I always wondered, they're filming they've never been broadcast, but they've
Mhm.
had all the cameras in the back, and ultimately a few years ago, Warren donated all that old archival footage from 1994 forward to CNBC. And so now you've got a guy who knocked him off and has a podcast. You can just listen to him instead of having to
Mhm.
watch him. You've got the transcripts available. And, I find myself when I'm walking 2 hours a day, listening to a lot more earnings calls, listening to more podcasts, your podcast, for example. But my vice, my crack cocaine habit is invariably I get to those old meetings and I've listened to them just a bunch.
Uh-huh.
But there's just so much wisdom and just the morality of how to treat shareholders and not abuse accounting and how
Mhm.
compensation works properly. There's so many lessons that kind of help drive how you think about how companies ought to operate. And there are so many businesses that don't operate
Mhm.
the way Berkshire does, very shareholder oriented, just massive integrity. Hard to pinpoint, any particular moment, but anybody that, and I'm sure anybody listening to your podcast knows Berkshire and they've probably listened to these meetings a million times. But if you've not, if you're a student or whatever and you haven't found Berkshire yet, no better lesson than the old chairman's letters and then the archive of the annual meetings.
I think the big profound lesson for me was that they're treating everybody else, all the shareholders, equally. And it's such a simple idea, but a very important idea that I could be a small, tiny shareholder with a single share and you could completely forget me, but they don't, right? So when I go to Omaha, I wrote an essay about it that it's not Buffett that's on the pedestal. It's not Berkshire that's on the pedestal. It's the shareholder that's on the pedestal. We want to hear the last question that you might have in the room, and they want you to get the same attention as somebody else that owns a lot of it. And I would love more companies to treat the last smallest shareholder the same way they do. So I think there's a profound lesson there. I want to ask you about your business practice and about the name of your company, because I think it will reveal to the audience a bit more about how you think, especially about risk. Can you tell me about the name, how it came about, and the whole story behind it in a nutshell?
So the Semper Augustus was the most inflated of the tulip bulbs
Mm-hmm.
in the 1637 tulipomania in Holland. In fact, just had our annual roundtable here in St. Louis last week, and it gave everybody Peter Millar tulipomania quarter zips. I don't know if you can see that. Um, so when we started the firm, had high conviction that we were in a bubble. The tech bubble was forming. The blue chips peaked really in 1998. The GEs and Coca-Colas. So those had started rolling over by 99, 2000. But then you had the tech bubble that peaked in March 2000. It was clearly a mania, and in all the reading that I'd done and loved the whole Wiley series of books. Um, had had found Kindleberger's Manias, Panics, and Crashes, which is
Mm-hmm.
a must read for anybody. Charles Mackay's The Extraordinary Popular Delusions and Madness of Crowds. So, in that one in particular, one of the segments, one of these manias throughout time, Southeast bubble, the South Seas bubble, but the original really was the tulipomania.
Mm-hmm.
Um, Tulips were originally kind of um, um, grown and found in Central Asia, Mongolia, Persia, so what's now Iran, I don't know, 10th century.
Mhm.
They didn't find their way until trade with the Ottoman Empire in the 17th century, and the Dutch always loved their flowers, and so the, you had kind of a strong economy with trade, and there were bubbles fomenting in real estate and asset prices, real estate prices, but the collectors of tulips wound up bidding the prices of these things up to where the Semper Augustus is the most inflated in 1637 would have fetched the equivalent of, I'd guess, $3 or $4 million in today's terms. And as McKay writes, the Semper Augustus, the most inflated, the most valuable of the bulbs would fetch the equivalent of a very nice flat on one of the canals.
Incredible.
And who knows the degree to which the bubble was widespread, how many people were speculating in tulips. There was evidently a futures market and a rough options market that developed on them.
Mm-hmm.
Whether it was widespread or not, don't know. The Semper Augustus itself, the most valuable bulbs, had a virus, and so they created this streaking. So if you've ever seen the Semper Augustus, this thing,
Mm-hmm.
it was brilliant, dark red and white streaked, but it wouldn't reproduce. In any event, believing there was a bubble when we started the firm, I thought the name was entirely appropriate to reflect the fact that we thought it was a bubble. Really had this in mind, thinking I'd probably always start a firm at some point. Really hoped that nobody would find it first, but we got to it, and I think it was a perfect name for the firm to start at that time. I mean, who would start a money management firm at the peak of a mania? But if you didn't own the tech stocks and some of the things that were so inflated, it turned out to be a very good time to start a firm and to be aware of the fact that there was a bubble in corners of the market.
Well, I was getting my degrees when the bubble was bursting, and my professors clearly lost their own money in that bubble. So when I was going to school, they were telling me that investing in the stock market, it's a casino. So until Peter Lynch's book, I didn't even consider going into investing, maybe business in some way, but not investing. And I'm glad I discovered that book. But at that time in the year 2000, you made certain predictions about the next 15 years. And I'm curious about the big picture idea. I know that predictions are hard. You even have this quote that after 15 years, we're less young and far less convinced about our ability to foresee the future. With age and experience comes humility, which the markets are very good at teaching. You have it in one of your letters. I'm curious about the predictions that happened back then. And if you can make any predictions about today, how do you think about the biggest opportunities, biggest challenges for the next 10 or 15 years? And I know you have some thoughts about it.
So that 2000 letter was really kind of for fun. At that point, I was not writing big, long annual letters yet. Really started shortly after that, making an annual letter a thing. But being a bubble, you were going into the year 2000, and the world was terrified that with the change of the millennium, computers wouldn't recognize, they weren't programmed to recognize. So a lot of money was spent and a lot of gnashing of teeth over something that wound up being a non-event. But, believing that we were in a bubble for internet stocks, had a series of predictions that wound up largely being pretty correct. Interest rates would fall from what were then 7% to 3% on long-term treasuries, which would have required a lot of deflation and real problems. Most of these internet companies will run out of cash and disappear, which most of them did. But the first prediction was Microsoft shareholders are going to lose money for 15 years. Well, Microsoft had been public for 15 years. They compounded at something like 65%. Revenues were growing at something like 40%. It'd be akin to a NVIDIA today. But the wonderful business, extremely profitable business, was simply massively overvalued. The stock was way ahead of itself, and it had a 620 billion market cap on 20 billion in revenues, and then they had a 37% profit margin. So the thing was doing 7.5 billion. But if you would extrapolate the growth in market value for another 15 years, you'd be in the quadrillions of dollars. and ultimately said it's going to take 15 years for the fundamentals of this business growing at a reasonable clip now that it's a larger business to catch up. And indeed, the stock had a negative total return, even including the special dividend and the regular dividends they started paying.
Mm-hmm.
And at a point, 6, 7 years in, the stock traded at less than 10 times earnings. It was 80 times earnings when I wrote that. We
Mm-hmm.
bought it at less than 10 times. So margins came in, still a great business, still growing.
Mm-hmm.
They hadn't yet figured out the subscription side of selling software. Stumbled a little bit in areas and ultimately got the cloud, but you wouldn't have seen that even remotely at that time or even when we bought the stock. But it was simply a bubble, and
Mm-hmm.
I think you've got pockets of that again today with a handful of businesses, and it's not just the Mag 7 or the Fab 5, but I would extend it to 40 or 50 or 60 companies, largely US, which make the cap-weighted S&P 500 extremely expensive. And so,
Mm-hmm.
thinking though through how the next 15 years might look, and I did the update on that letter 15 years in, and so now that we're talking about it, I guess my 2029 letter, I'm going to have to revisit the second series of predictions. The ones I totally screwed up were related to sports. And I've essentially said twice that the commercial nature of sport will decline,
Mm-hmm.
which clearly it has not. The money in professional sports and even collegiate sports is incredible. Perhaps the notion that the NFL is going to open itself up to selling fractional interest to private equity
Mm-hmm.
may be the sign that the commercial nature of sport may indeed decline going forward. But I'm not going to touch that middle rail again. Um, I think I've been very concerned about debt
Mm-hmm.
um, in the system for a very long time. I thought when total credit market debt reached 250% in 2000 that we had a problem. Getting into the financial crisis when the Fed started ballooning its balance sheet and has subsequently since 2007 took it from 750 billion up to 9 trillion back down to 7 trillion today. But that was a 10x growth in the Fed's balance sheet.
Right.
Total credit market debt, since we run these enormous peacetime budget deficits, the federal component of debt is well north of 100%, kind of in either case, whether you include the privately owned portion of debt or the portion that the Fed owns. But we're going to have to reconcile this, and you've had the inflation of the last few years that very much came with the pandemic fueled money.
Mm-hmm.
And I'm not sure that once inflation is out, it can easily be put back in the bottle. So my guess would be that with the interest on the federal debt now running north of $1 trillion on a total federal expenditures and budget of
Mm-hmm.
something like 6 trillion, these are huge numbers. I think you usually will see a debt bubble reconcile itself with a debt deflation, but that involves a central bank willing to tolerate the cleansing of the system where the creditors become the equity owners. And we've got 40 years now of our Fed and central banks globally in the industrial world not allowing garden variety recessions to run their course. And so you've kind of gone past the point where they're going to be able to do that. And so, if you're going to run deficits at 6, 7% of GDP, we were running 15 and 16% in the pandemic,
Mm-hmm.
which was incredible. I mean, that rivaled what we were spending in the world wars.
Mm-hmm.
An easy way to value the debt is through inflation. And so, they're targeting 2%, but if you go back to the period of the late 60s through the early 80s, where Volcker, they say, broke the inflation. I think it was already broken by the time he came to the Fed. But if you look at and I got this in, I think, my letter 2 years ago, I kind of studied the period, and the Fed was generally ahead, was matching the inflation rate. So inflation would run up, and the Martin Fed and various subsequent Feds would chase and drive interest rates higher, the Fed funds rate higher. They'd break inflation, and it'd come in, and they'd lower rates. And so they really kind of matched monetary policy to what inflation was doing, but they never got it fully under control.
Mm-hmm.
And so financial assets were a disaster during that period. If you were a passive owner of the S&P 500, The Dow was 1,000 in 1966. By the lows in 1982, it was 778. And you had these rolling bear markets, 20% in 1966. You had a 30% decline in kind of the 68, 69 period. 73, 74, of course, was the big one. The Nifty 50 peaked in late 72. You got a 45% decline in the big averages. But essentially, for 16 and a half years, you made the dividend. I mean, your price was flat for a long time when inflation averaged 6 or 7%. So you didn't want to own credit, especially long dated credit, because interest rates rose, and we didn't have a 30-year treasury. We had a 20-year treasury, but bond prices were eviscerated. It did a lot of damage to the banking system, a lot of damage to insurers. Again, passive owners of stocks did perform terribly. I've come to say, well, who won the 70s? Well, Warren Buffett won the 1970s. It was having capital coming into the business. It was diverting capital from some of the failed businesses that were big acquisitions, diversified retail, blue chip stamps, even the original textile business completely took the capital out of it and closed the whole thing by 1985. Warren had money in the 1970s, and he had it at opportunistic times. And so that's when he bought the Washington Post and bought Geico and bought these businesses for a song. And the subsequent returns were glorious because he was bracketing the return series from each of these key acquisitions at very, very low prices. And so if we have a rolling inflation and we try to devalue the debt that exists today slowly through 3, 4, 5% inflation over time, I think you probably get a mimic where you've got a rolling stock market and the ability for active investors, value investors, to trim the expensive and buy the cheap, which is what we've done for the last 26 years as Semper. And I think that if that evolves over the next 15 years, the value investing world, which has been wandering around the desert for seemingly the last 40 years, should have some advantages.
You're making a strong argument in favor of active investing, and I agree. That's what I've been doing for 20 years for clients, wealthy families with multi-generational fortunes. And I realized that in the setting that you presented, from a single stock, Microsoft, that was at a peak in 1999 and took, I think, 10 or 12 years to reclaim the same price and come back just to break even. You could apply to the whole market. I remember a statistic, 1969 until 1982. The market hasn't done anything. But then I've seen a piece of research that I don't remember the details of, that there were quite a few stocks that have done okay, actually very well, if you pick the right ones through the 70s. So if you look at the index hasn't gone anywhere, as you said. But at the same time, as you mentioned, there were quite a few opportunities, not just the ones that Buffett found, but other ones that if you looked and you did your research, you would have found opportunities in those markets, especially if you had some cash on the sidelines. And we'll come back to the cash in a minute. But I want to ask you about what kind of businesses you like. And I kind of have an idea, but for the benefit of the audience, where do you go to look for opportunities?
Hard to, I wouldn't put what I do and what Semper does in a style box. I like to say we're trying to find good businesses, great businesses, quality businesses, trading at a discount to what we'd call and you would call intrinsic value, run by honest management teams that don't abuse shareholders with accounting or with excessive compensation. That said, we do a lot of different things. I mean, love to find businesses that we think are kind of classic compounders that we can own for decades. We'll buy cyclicals and be willing to trim them and sell them when they get expensive. We'll do some arbitrage. Occasionally you get one-off special situation where we'll put a lot of capital to work, but you're always looking for a margin of safety and the price for what you pay, for what you get. Gravitated toward insurance, property casualty insurance and reinsurance, and obviously through Berkshire, but through quite a few other holdings over the years. I think we've got a pretty good understanding of how the underwriting cycle works. in what really is a bad business. I mean, the property casualty industry is not a great business. We've owned banks and thrifts at times, but I think those are trading sardines.
Hmm.
If you look at in a 30-year lens, the vast majority of banks are terrible businesses. They get recapitalized in a financial crisis like 08, 09. They under reserve for coming loan losses late in the economic cycle, and they're just not good. Your big reinsurance companies, the two biggies in the world, Swiss Re, Munich Re, have been terrible for the last 30 years. They're just, the industry in aggregate is not very profitable, but you can buy these things at times when they're very cheap. The Berkshires of the world are aberrant because of what Warren's been able to do. We've got a lot of money invested in retail at the moment, and $3 stores. And we've traded those. I bought Dollar General for the first time in 2016. They'd been taken private in 2007 by KKR. They came out 18 months later with a lot of debt on the balance sheet at KKR private debt at 10 to 13%. They had to get all that refinanced. And at a point, the world was convinced that everybody in retail was going to lose to the Amazons of the world, to internet retail. Well, the Dollar General's got a largely 80% rural footprint. Much of what they do is low-end customer that shops at Dollar General during the week for consumables and finds their way to Walmart 40 miles down the road on the weekend. But you're not going to go 40 miles to Walmart if you need toilet paper or you need toothpaste. And so Dollar General fits the bill, and they're competitive on a price point. They're maybe 1.5% premium price to a Walmart, but the consumer knows they're getting a deal. In any event, it's a business that's very contracyclical, does very well in recessions. Why? Well, the government gins up money and they increase their food stamp programs, SNAP, the Supplemental Nutrition Assistance Program. So if you think about a financial crisis in 08, 09, their same-store sales comped at 9, or over a long period of time, they're not going to comp at much more than the inflation rate. In the pandemic, not only do you have an increase in SNAP, but you had a huge increase in tax credits, the child tax credit, the earned income tax credit, based on your tax return. If you made below a certain income amount, the government simply, without requesting it, just sent checks to everybody. And so the lower income and middle income families had all this surplus cash. What'd they do? Save some, but they largely spent it. And so in a Dollar General's case and the other dollar stores, their sales of discretionary items versus consumables went off the charts, and same store sales comped at 15 or 16%. The backside of that, though, is the free money goes away, the savings disappear, food stamps get peeled back by each state, the tax credits revert back to where they were. And so then you overlay all the inflation we've had in the last few years. The low-income consumer, 60% of Dollar General sales are households that make $30,000. I mean, way below median household income. Those folks are, living paycheck to paycheck. And as Dollar General says, they're running out of money by the end of each month. And so wages have to come in. But naturally, you had the wrong mix of discretionary versus non-discretionary in the stores. We have a tolerance of shrink, which is stunning across all of retail, with the exception of maybe Costco, because they have a different clientele and they check the receipt when you leave and things are sold in larger bulk and it's more of a cult. But retail has to fix shrink. And so Dollar General's got all these things they've got to fix. They underspent on maintenance CapEx. You really need to touch each store every 6 or 7 years, and they were doing 1,000 a year. They got behind as the store count grew. But when you have an earnings miss and Wall Street thinks you're still going to make 10 something a share, and now you're going to make 5 something a share, there's no liquidity. So much of the market is made up of passive ETFs, index funds, sector funds. So now, because the insurance industry has been very profitable for the last year and a half, 2 years, a lot of money's flowing into the insurance sector through passive flows. And when a Dollar General, capital allocation wise, when the chairman, Mike Colbert, who I think very highly of, but I think he made a terrible mistake in that they were running the AutoZone playbook. Bill Rhodes from AutoZone was on the board of directors. AutoZone's shrunk the share count by 80% over the last 15 years or so.
Mhm.
Dollar General came out of the IPO with, I want to say, 340 million shares. They're at 220 million shares today. And for most of the period when they were spending a big chunk of operating cash flow buying shares back, they were cheap.
Mhm.
But then you get in the pandemic, when store revenues, again, same store sales were up 16%, margins exploded because they sold more discretionary merchandise versus consumables. They over-earned and made the huge egregious error of not only buying a bunch of shares back when I was selling my shares to finance the purchase of energy in 2020, when the stock was very fully valued in the low 200s. They put $3 billion in debt on the balance sheet to buy shares back, which was just a terrible waste of capital. So you put it all together, and now you've got a balance sheet, given that margins have come back, and I don't think margins are going to go back to where they were in 2019. And this is true for Dollar Tree, which owns Family Dollar. It's probably true to a degree for Five Below. People don't realize how tough retail is in an inflationary environment. In the 1970s, retail was largely not publicly traded, but it was mom and pop. I mean, Walmart was just growing. You didn't have a bunch of publicly traded retailers. I mean, the stock market was made up of different sectors. And so, but you get an overreaction. And so Dollar General can't buy shares back now because they've got to preserve the balance sheet. And eventually here, they're going to have to take cash flow and pay down the debt that was taken on to buy the shares back at the wrong prices. So there's no support under the bid, and the stock's trading at a price that we find extraordinarily inexpensive. So long segue, but to get to the Dollar General, I just took a insurance company that we had 8% of our capital in at cost that has doubled in the last year and a half. We were the fifth largest shareholder. It took me a month and a half to sell it, but it became 15% of our capital. So I'm completely out of it now, and use the proceeds to increase my position sizes in Dollar General, Dollar Tree, a handful of other names in the portfolio. I'd been financing some purchases with the same energy companies that I bought in 2020 to buy some other things in the last couple of years. So we're pretty active at the margin with not high annual turnover, 15%, but
Mhm.
taking from the deer to finance the purchase of the cheap. And that tends to keep the portfolio pretty undervalued. And so we like a lot of different things is what would have been the the shorter way at least to answer that question, but generalist very much. And so we'll do a lot of different things in a lot of different industries, but generally when something's out of favor and we think that the short-term issues can be remedied, and then sometimes you get to buy most often you only get to buy your compounders when the overall stock market declines. Then you have to make the decision, well, do I want to trade out of something that's really cheap to buy this business that I want to own for 30 years? And it all boils down to opportunity cost. So that was a
All right.
long answer.
No, I like that. It makes sense. You go wherever you find the opportunity. For the benefit of the audience, any stock we mentioned throughout this conversation is no recommendation. Do your own research. Goes without saying, but let me repeat it. I do want to mention how you look for a certain quality in those businesses, but then in your writing, you mention the other side of the equation, which is the price. And I find it really, I can relate to it and I agree, but it's something that gets lost sometimes in the conversation. People find a business they fall in love with and they forget the price. And if you actually want to make money, the price matters as much as what you just picked as a potential investment. Can you talk about that price side of the equation that's as important, if not sometimes more important than what you actually picked?
Well, the best business in the world purchased at the wrong price can be a terrible investment.
Mm-hmm.
The Microsoft example from my 2000 letter is a perfect example. The shareholder lost money, and even running the whole series, their profit margin at Microsoft dropped from 37 to 22. It's back to 37. It's was then 5% of the S&P 500. It's now 7 or 7.5%. This is an incredibly great business. Their revenues are up more than 10x. They were 20 billion. They're what, 250 billion. The margins are back to where they were, but your total return, even with this recovery in margins and all the growth, is still single digit. Now, it's ahead of the S&P 500, but it's way below what Berkshire's done over that time period, and it's way, way below what we've done over that time period because the price was wrong then, and we owned it in the interim. I would say take the same example today. Apple is no doubt a phenomenal business, but it's doing 400 billion in revenues. I can't get the profit. I can't get the margin much off of 27%. growing nowhere near as fast as it's grown in recent years. Had a couple of years where the revenues didn't grow. They're finally clipping along at 6% in the last quarter, but I can't get to much more than 6 or 7% top line growth. And if you're not going to get margin expansion, what do you do with operating cash? Well, they've bought a lot of the stock back, which made tons of sense when it was cheap, when it was trading at 10 times earnings or less when Warren was buying it 2016 and 17. But here at 30 plus times and a 3% earnings yield, I find it to be a destruction of capital. I mean, the same great business at one price was, produced a huge return for the Berkshires of the world. But at today's price, at best, it's going to take 6 or 7 or 8 years for the business to grow at 6 or 7% to grow its way into the valuation. I mean, the thing shouldn't trade for 33 times. It should trade for probably 15 times. Costco, business that I've never found. It's the best business I've ever studied. We've owned it. I still own it in small part in taxable accounts where I've got a very low basis and older clients where you're expecting a step up. But when I bought Costco, I mean, here's an example of a business that was so good, but the way the business is structured was masking the underlying profitability. So if you know the business, when they open a warehouse, a new store, it takes 7 or 8 years to get enough members signed up to get full throughput in each of the units. And so they don't really reach full maturity and profitability for a long time. So when I bought the thing for the first time in 2004, 20 years ago, they had 350 stores. It looked like they were earning 11 or 12 on capital, but the company's always opened about 10 to or 20 to 25 warehouses per year. So they were growing the square footage of the enterprise at, say, 7.5% then, but a third, 40% of the stores were under earning what their full mature profitability would be. So it was earning way more than 11 or 12 on capital. It was earning then probably 15 or 16. Well, fast forward 20 years, now they're still opening 20 to 25 stores. They do it at the cadence at which they think is appropriate. So you're growing the square footage at 2.5%, not 7.5%. Now you've got 900 plus warehouses. They're growing internationally. But the business won't grow as fast. And really at the point where I bought it for the first time, they started paying their first dividends. And reflective of the fact that we're not going to just spend money for the sake of spending money. We're going to build warehouses deliberately in places where we can get the right tax credits and make the whole thing work, where you've got enough density of population where we're not going to cannibalize our other warehouses. So, and same store sales will grow double the inflation rate. So if inflation's 2, they're 4. If they're 3, they're 6, whatever. But similar to the Apple example, I can't get the revenues of Costco growing much more than 6, 7, 8% per year. Over the duration of this last 20 years, the net margin has grown from 1.7% to 2.7, 2.8 today. I have a hard time getting the margins much above where they are. I mean, particularly where the membership fees essentially equate to the profitability of the enterprise, and they're always driving cost savings down to the customer. But, where I paid 20 times, what was really more like 15 times when you do the math on assuming the entire store base then would have been mature. Now much more of the store base is already mature, and these units are earning low 20s on capital, but the thing's trading at 54 times earnings. It's similar to Apple. I mean, you're at least 6 or 7 or 8 years ahead of itself. It's not worth 54 times. It's not worth an earnings yield less than 2%. I mean, you'd literally be better off in a 10-year or 15-year treasury, earning 4.5 than Costco, because maybe it's worth 25 times. You've got to cut the multiple in half. And so these are examples of where the price in these great, great, great companies can be such a headwind that you produce a mediocre return. And at some point, as the things re-rate back to a more normal valuation, you wind up losing a hell of a lot of money for some period of time. So price is critical to the investing equation.
When you find a compounder like that, there's a certain challenge, because at some point other people will appreciate it and then fall out of love with it and then appreciate it again, especially if you look at a longer period of time. But at the time when too many people get excited about it, it gets overvalued. And it's a bit of a challenge for somebody like you and me who wants to have a certain discipline that we would sell it and get out when it's trading at 35 times earnings, although it's going up to 60 times earnings. Who knows in between, right? But then there's a challenge of going back to it. And I notice that a lot of investors have a hard time going back to it. How do you think about it? On one hand, valuations, can they push you out of the idea, the holding? Do you have the audacity to go back?
So what I've learned to do, and ultimately realized that Lou Simpson had done the same thing in running the Geico stock portfolio. I've taken to generally keeping some small number of shares on hand, which forces me to look at it every day. If I want to buy it at a better price, I'm paying more attention to it. So at Nike, for example, we made a bunch of money and I took it down to 0.5% 3 or 4 years ago at very, very full valuation. But a 0.5% position is not going to kill me. And just this year, as the stock has gotten pretty undervalued again, I've taken it up from 0.5% to 1%. And got to make the determination: is this as good of a business? I mean, they've got China issues like a lot of other companies. I can tell you, when I wear tennis shoes for more dressy, I'm wearing On, publicly traded. Deckers owns Hoka. I'll never not wear Hokas for my 2 to 2.5 hour daily walk. They're just incredible footwear. And you think, well, at the margin, I mean, Nike does 50 billion in revenues. 2/3 of that is footwear. These things are doing 2.5 billion, 3 billion a piece in revenues. So, I mean, they've taken serious market share from Nike. And so the classic compounder, everybody knows it's a great company, but now I've got to say I've not made it bigger than 1% because I don't know. I mean, I don't know where this thing's going to grow. They were driving business through their apps, and really not driving as much business through the apps. So I'm not sure the margins can escalate at the same rate that I thought they were going to escalate. So you've always got to, whether you've got a business that you think's a 30 or 40 or 50-year compounder, you always got to sit back and say, what could go wrong? What is going wrong? What might make this not as great of a business as it had been previously? But if it's in the portfolio and we decide fundamentally this is now a broken business, we'll sell the whole thing. But I've made so many mistakes over the years. Ross Stores, I kind of wrote about years ago, and people have commented on it. But in the tech bubble, which again, we started the firm in late 98, early 99, you had a bifurcated market. So the internet stocks and the big second iteration of the Nifty 50 were so expensive, but there was so much value under the hood, buying fire truck manufacturers and little insurance companies and thrifts at single-digit multiples to earnings, low double-digit multiples. Well, Ross, great retailer, still a great retailer, no debt. They had probably the same number of stores as Costco had when we bought Costco. So I don't know, 350, 400 stores. The runway to open stores was really, really, really long. But the thing traded at 10 times earnings. Stores break even a lot sooner, so it was more appropriate. The margins were probably what they were earning, but there was a huge runway to retain a bunch of capital and open a bunch of stores. And the boxes themselves were high teens returns on capital. So it went from, as the S&P fell 50% and the NASDAQ fell 80% and unwound that cap-weighted bubble that existed in stocks, we happened to make a bunch of money from 2000 to 02. Value investors generally, who had suffered mightily in the late 90s, generally fared pretty well. So we weren't alone in making a bunch of money in 2001 when the market went down 9 and 11%. We were up over 20% each of those years. And that was simply a revaluation of the things that had gone begging. The money that left the cap-weighted tech bubble, to some degree, found its way into the more value-oriented world. And so Ross traded up and we made something like 2.5 times our money in a couple of years. And I thought, oh, geez, now this thing's trading at 20 whatever times. And, I paid 10 times for it. Geez, I mean, it's nothing but downside from here. And so I sold the whole thing. And if you look at the returns over the last 15 and 20 years, after we sold it, it's 15 bagger. It's one of the best performing stocks in the stock market. And it was so knowable what they were going to do, opening these very incredibly profitable boxes. it was a ridiculously bad decision to sell that thing because I never came back to it for whatever reason. Maybe I was anchored to the fact that 10 to earnings was the price that I was trying to get again. I don't think that was it because it was worth a lot more than 10x, but
Hmm.
never got back to it. And so even Costco, like I said, we've got it in a few taxable accounts where for tax reasons, I'm just not going to sell my $29 basis stock at $950. And
Hmm.
uh, but
There is a certain psychological barrier that I found about going back to an idea. And the second thing that Professor Asov Damodaran pointed out to me, I recorded with him and we talked about his new book. He talks about the life of a business. And it's something that I was aware of, but he really sharpened my focus that when you look at the same company over a period of time and you go back to it after 10 years or 20 years, it might be a different business. It might be at a different stage. And I don't want to pick on Nike here and obviously no recommendation of any kind, but it might be a different business today than it was 20 years ago. Different growth stage, different margin potential improvement, and so on, right? So when you go back and it sounds familiar, it might be a different story. In some cases, it's a better business. In many cases, it's not as good as it was. And I think it's worthwhile to look at it from that perspective that maybe it's a different story and then it's a different price, right? And then it's a different set of expectations going in. But the bottom line is, I find it personally hard to go back to an idea. And sometimes I find it easier to just hold on to it for a period of inflated valuation to a point than selling it and making myself go back to it.
yeah, I still like the idea of having a few shares laying around because it
Makes it easier.
makes it easier to buy it again. But you've got to operate with the assumption that any business that you own can be disrupted.
Yes.
And you're seeing it happen faster as the years have gone on. Disruptive forces in technology, labor differentials, whatever it is. You've always got to be vigilant about what can go wrong. And you spend 80-90% of your time on the what can go wrong side, the risk factor side, than you do on building a model and growing the top line and bottom line gloriously at the same rate at which it's grown in the last several decades. Yeah, I agree with that.
It's an aspiration, but I like to think that I operate with an infinite investment horizon. Given the clients that I have, they have an open-ended investment horizon. It's the money for the next generation in many cases. And you think about time and patience quite a bit. In my mind, patience is the last advantage we might have. Everybody has the same access to research. Everything is online. If somebody wants to read the filings, they can read the filings. Everybody has the same advantage, and there are a lot of smart people doing it. So I never argue that I'm faster or smarter than anybody else, but I'm trying to be more patient. Can you talk about time and patience and how time is the last arbiter? At the end of the day, the time will show, as in the examples that you presented earlier.
Yeah, if you go back to when we were in school, and I'm sure you were being forced to learn the efficient market hypothesis as
Yes.
well. You had the weak form, the semi-strong form, the strong form, and it effectively all said all the information that's available is already in the price, and
Yeah.
you're not going to be smart enough to figure it out, which is just crazy.
Mm-hmm.
I think a better way to frame it, and I touched on it in this year's letter, my past letter, better to phrase it in the context of Mr. Market, where in the short term, the market and stock prices can be wildly inefficient and mispriced. But as time passes, Mr. Market gets it right. Going back to the banks, even a U.S.
Mm-hmm.
bank, these 30 years of just terrible returns, the market gets it right over time. The notion that the market's broken and value investors are out to lunch and have no advantage and can't find mispriced assets is just wrong.
Mm-hmm.
A mispriced asset, if you have patience, is going to remedy itself.
Mm-hmm.
A disciplined management is going to buy a bunch of shares back.
Mm-hmm.
A private equity acquirer is going to come along. A publicly traded acquirer is going to come along.
Mm-hmm.
Eventually, the market's going to figure it out, but it doesn't happen overnight. And so, yeah, patience is mission critically a virtue
Mm-hmm.
in our world of investing. And then you've got to have the right clients on hand to allow you to have patience as an investor, because especially newer clients, they want to measure your 6-month performance against the market and or 1 year performance or two. But you can't control stock prices for 6 months or a year or 2 years. What you can measure is the underlying value of your companies, and are they getting more valuable? Are they doing intelligent things with capital and retained earnings? And the market gets it right, but it's not an instant get it right. Even activists struggle with trying to extract value immediately. Again, with passive flows being what they are, and not a lot of liquidity, you have a target yesterday, have a pretty modest miss, and the stock blows up by 20+%, and it drags down Dollar General intraday by 5, and Dollar Tree by 5, and Five Below by 5. Well, I was on the phone with a client last night, who imports a lot of stuff from China, and he even observed, his world, the consumer's in trouble, and but he noted that, Target can't be worth 20% less one day than it was the day before, simply on a 3-month earnings number. It just makes no sense. Now, I was going to say, is Target being disrupted by Amazon, and are they losing share to Walmart, and will that permanently be the case? So, those are appropriate, but whoever's on the trigger saying, oh my God, there's a earnings miss by a few pennies, whatever the projection for the next 6 months or 12 months is, you miss the target. It's just insane. And given this lack of value, capital, liquidity, you get these extraordinary price moves. Well, that's Mr. Market in the short term being in his inefficient form. But in the long form, Mr. Market's going to take the very efficient form, and the market always gets it right eventually.
Well, it's fascinating, and I don't want to take apart the efficient market theory here, but if you have participants that actually think and make decisions, then the stock market could be pretty efficient. The point is that it's not the case. And you have those big gap downs that show you that although you could have traded in Target specifically one day and the other, how come from day 1 to day 2, the price differs by 20%? And Target is not the only one. I've seen more of those gap downs in the recent years.
Well, I owned several gap downs in recent years.
Right. So you feel like the theory doesn't work because clearly somebody's not paying attention until they pay attention, and the price shows up at a whole different level the next day. And I don't know which one is right, the day before or the day after. Who knows? There might be an overreaction the day after. It might have been just people not paying attention the day before, but it's fascinating to watch. And I think for people like you and me that actually look and watch and pay attention, there are more opportunities in the market like this. So in a way, I invite the fact that fewer people are paying attention.
Yeah.
And it's not a bad thing for active investors that there's more passive investing, because it means that there are fewer people really competing and trying to figure out the true value of the businesses that we buy. So I don't know what the future holds, but it's a whole separate conversation. I think Bogle made a point when he was pushing passive investing that it piggybacks on active investing. And there's a certain point when there's so much of the passive investing participation that the market fails to work at times, which for you and I, that's an opportunity, because in any other world, you wouldn't see a 20% gap down in a large market cap overnight.
You had an early iteration of very high passive flows in the late 90s. It wasn't just chasing the tech bubble, but passive investing was consuming a larger corner of the market. And then, of course, the S&P and NASDAQ got so far ahead of themselves, they only could revert down to Mr. Market's assessment of long-term intrinsic value. And S&P fell 50%, NASDAQ fell 80%. That was an inevitable. The underlying value of the market was way below the 1,500 where the S&P traded initially in 2000 and then again in 2007. And you've had a very long period where from those secular peaks from 2000, the market has been a pretty awful place, at least compared to its historic return.
I have to ask you about the cash in the portfolio. We kind of touched on portfolio construction, but you write about it in your letters that having cash can be a drag, but on the performance, but it can also come in handy. How do you balance the two? Because you might need cash, and you talked about Buffett having the capital to invest in the 70s, and I'm sure you probably had extra cash available in the year 2000 to go in and buy those value opportunities. How do you balance the two? Because you might look not so smart when you're holding a lot of cash and the market is rising.
What I've learned, and I wrote about it in my last letter, is cash is a tough asset to hold. In fact, somewhere around here I've got.
You make a point how much you lose in performance for how
Yeah.
much cash you hold.
We have clients that have to have cash. We have foundations that give away 5% a year to charity. We've got retired families that live on a portion of their income, and we've got clients that simply direct cash. I've learned that once we're fully invested, and institutional investors like to be pretty fully invested right away, which is great because it takes the decision of having cash out of my hands. I like that. I also think if you're running family money, you should really only buy the things that Mr. Market gives you that are cheap. And so, with new money today, I'm about 75% invested. So I've got a 25% cash reserve that I hope I get to put to work quickly, which means prices are falling and I'm finding opportunities or the overall stock market comes in. But once I'm fully invested, I like to stay fully invested. When I'm buying something new or I'm adding to a position, I'm generally having to put a trade ticket in to sell something in the portfolio that's more fully valued to finance the purchase of something that's cheaper. I like staying fully valued. And the reason for this is if we've had, I'm going to estimate 17% cash on hand for the clients or for the whole aggregate of our client base, but the clients that just have 30 and 40% cash and or fixed income reserves, equity only return gets shaved by 170 basis points. But that's with a bunch of cash. That sounds pretty innocent, but that is a massive, and you think, I'm sure you have the same thing. We have a lot of clients that hire us and they've been following us for a long time and they generally find the overall stock market to be expensive. And we've got a lot of clients that come to us with big cash reserves. And they say, God, we'd love to get you in March 2020 when everything's down by a third, because when money comes in during those periods, you just shovel it in. And even with clients that are sitting on cash and they've got cash that they're holding on their own, say, whatever you've got, send it in, because this is one of those rare opportunities to put money to work. But think about just compound interest being what it is. The richest man in Babylon. You grow money at 10%. You're 120. You're up 21% after a couple of years. You're up 46% after 4. You're up 61% after 5. You're sitting in cash earning 4 or 2 or what's averaged, I think, 1.7, 1.8% for the last quarter century. For much of this period, the Fed was suppressing the money rate, holding it way below the inflation rate, and just eviscerating those that were sitting on long-term cash positions. I mean, if you're 5 years in and you've made 61%, you've got to fall 38% if your cash is earning nothing. If your cash is earning 4, you've still got to fall 25%. I mean, 10 years in, if you've grown each million to 2.5, 2.6 million, you've got to fall 61%. So think about the largest drawdowns over time, 30% in the pandemic. You were down 18% in 2022, but I wouldn't call that a secular bear, even though I think 2021 is probably going to be a secular peak. You're kind of back to those valuation levels today, given the run up this year in the S&P and the NASDAQ, 25, 26%, whatever it is. Think about the financial crisis. You were down by 60% peak to trough. Back to the 2000 tech bubble, S&P was down 50%. 73, 74, down 45%. But for 16 and a half, you made essentially 1 or 2%. You made your dividends. 29, 32, down 89%. But you didn't stay down 89%. So, I've come to, when clients work with us, families, individuals work with us, and we talk about cash allocation, really since the Fed suppressed rates in the financial crisis, we've gone to clients that want to have cash reserves and have said, look, this is a bad asset class. Even fixed income is a bad asset class. I'd rather own a business that retains a portion of earnings because they've got something intelligent to do with it. So to the extent I get dividends, fine. If you're taxable, we've got to pay some money, but then I've got to put it back to work at control premiums and pay whatever multiple to earnings I'm getting for the companies I'm reinvesting in. But if companies have the ability to reinvest in their businesses at 15, 16% returns on equity capital, that's so much better than owning a 10-year treasury at 4.5%. Your total return is going to be predicated on your reinvestment rate for your coupons at the same 4.5% or 5% or 3%, whatever it is. It's the reinvestment of capital, not at the money rate, at the
Mm-hmm.
fixed income rate, but at a materially higher rate is what makes the equity class, be it publicly traded or private, so much better as a
Mm-hmm.
long-term holding. I mean, point is, it does not take that long, and you don't compound linearly at 10% even or 11% or 11.5% even. I mean, it's lumpy,
Right.
but it doesn't take many years of compounding to where you'll never recover the drawdown by having cash for too long. And
True.
so, um, Berkshire's got a big cash position at the moment.
Mm-hmm.
Until this last year and a half, it's not been aberrantly out of line to where it's been in the last 25 years. But this is a function of Warren finally saying, okay, even though I said we're going to keep Apple, he had sold 10% of the Apple position in 2020. Both he and Charlie said it was a mistake. But then it traded at north of 30 times earnings. It was half of the Berkshire stock portfolio. And he reasoned that, my God, I can't have this business, regardless of size, at this multiple because I'm not going to make any money. And I'm better off paying some taxes in it.
Mm-hmm.
So his universe is different than our universe because he's got a $500 billion insurance reserves, 100 of which is probably required as either cash or fixed income to support their underwriting.
Mm-hmm.
But you've got, of the current cash balance, a couple $100 billion that can be put to work.
Mm-hmm.
He's not going to buy Costco at 54 times. He's not going to buy Lilly when it traded at a 900 billion cap. So his universe has been driven up by these passive flows to where these 50 or 60 companies, which is really all he can buy fractional shares in,
Right.
are largely pretty expensive. He's not going to go force money in to buy entire companies, control premium, and own 100%
Mm-hmm.
if you're competing with private equity. And so
Mm-hmm.
you sit on cash for a period of time. But that's the high class problem of having made so much money in the portfolio, and his discipline of saying, look, my universe is not attractive at the moment, so I'll have cash. But if it takes 6 or 7 or 8 years and you could have bought something at a little bit lower return, but that's going to earn you way more than cash, even there, Berkshire can't afford to have
Mm-hmm.
an aberrantly large cash position for too long because you never recover from it.
I would rather own businesses at any point in time. There's a small challenge that you brought up when you have a new client. So those clients that have been with me for 10 years or more, they have a different way of looking at it, and they have a different, anchor and framework of what the portfolio is today, what it was. So even if it drops through the drawdown, it's not a major issue. With a new client, if you go all in 100% on day one, you run the risk of a lot of disappointment if you go in at the wrong time. So the first year or two are a fascinating time for the manager, from my perspective, of, getting to know each other, but also not disappointing somebody new too much because of being 100% invested.
Yeah. And it's a coin flip, and it's hard.
Mm-hmm.
If you happen to have portfolios for clients that were new in 6 months prior to the March 2020,
Mm-hmm.
And you had still 20-30% cash that you hadn't put to work yet,
Mm-hmm.
instead of being fully invested at the beginning of the year, we made 12% that year for our fully invested clients.
Yeah.
With money that came in. But we had clients that made 50-60% because we put a whole bunch of money to work
Mm-hmm.
that wound up kind of reverting back to prices that existed
Mm-hmm.
at the beginning of the year and not down by a third or more or whatever. And so but those drawdowns abruptly like that don't come along very often. And so
No.
we really do try to get money put to work, and
Quickly.
we'll do it at the position level. And so even Berkshire, which has traded in the last year much closer to my appraisal of intrinsic than it has in the 25 years we've owned the company, even at a moment at its high for the year, traded at my intrinsic value estimate from last year end, which you can find in my 2023 level
Mm-hmm.
letter. But the business is worth at least 10% more this year than it was worth a year ago. And so now today, with the stock off its high, it's trading at probably 85 cents on the dollar of fair value. But I'm not buying it, and have not been buying it in the last several months at a full position size because
Mm-hmm.
price matters.
Price matters. I actually had a client that I was onboarding at the beginning of 2020. I remember how different our conversations were from January to February to March to April. And I don't know if I had the foresight or I was just disciplined and patient, but we slowly went in, and then March and April we sped up how quickly the portfolio got invested. But I can't take full credit for what happened. It was just the opportunity appeared in front of me. But I'm grateful that I took the time to go in instead of going 100% in January, February. And I kept that lesson in my head. And I agree with you that those drawdowns don't happen every day. When they do, you kind of want to hedge your bets and go at a certain pace. You brought up Apple, and you write about the Fabulous Five and the Magnificent Seven, a handful of companies that have disproportionate share of profits, as you show in your letters, disproportionate share of the market valuations. But you also follow Berkshire, and we both know that Apple played a big role in Berkshire's performance in the last few years. Just to be cheeky for a second, can you imagine Berkshire without Apple? Since 2016, where would we be?
Sure. Total assets wouldn't be as high as they are, north of 1.1 trillion. I mean, you took a $36 billion investment in just a handful of years. Had they not sold a share, Warren had over 1 billion shares, maybe 1.07 billion. It would be a 230, $240 billion position today. And he didn't top ticket, but having taken 70% of the position off, added a lot of value to the company. But you can say the same thing about the purchase of Coke in 1988 and 89. I mean, in a very short number of years, less than a decade, took a $1.3 billion investment up to 18 billion in the middle of 98 when Warren didn't sell it, but did the next best thing and bought Gen Re and diversified the stock portfolio and the Coke position. I mean, stocks then were 115% of Berkshire's equity. Post Gen Re, they were 70% of Berkshire's equity. Had they not bought Washington Post in the 70s and Geico when they bought it originally, had American Express. I mean, these positions that over decades compounded at 15, 20, 25%. The big winners have dramatically beat the S&P 500, even without the benefit of the leverage you get by owning an equity portfolio inside an overcapitalized stock market. So, I mean, had Berkshire not bought National Indemnity in 1967, it'd be dead. I mean, if he just ran a textile business, it was going out of business.
Right.
Diversified retailing went to zero. Blue chip stamps went to zero effectively. But the pivot away from these businesses that he and then ultimately he and Charlie recognized were dying, had the foresight to take capital out of those and redirect them into public securities. So you've heard Warren and before he passed, but in just recent years, they've acknowledged, look, we haven't made that many really great big decisions, but it's not like you're hitting home run after home run. So Apple would just be one of many. It was no more important than Coke was, than Washington Post was. The railroad, I mean, my God, when the economics of railroading improved in a deep financial crisis, you buy the Burlington Northern for 35 or 36 billion. It's worth 120, 130 billion today. I don't think it's going to get any better. And if I own fractional interest in it, you might think about selling it because I don't think it's going to get better. And I don't think it can absorb retained earnings. You had a handful of years where there was a lot of CapEx you can spend on improving the infrastructure of the rail, but they've done that. But I mean, you added $100 billion in value and have largely taken every dollar that the business made and upstreamed it to the parent company. I mean, most of the profits were not retained, unlike the energy operation. So he bought a tech company. I mean, he's a good international investor. The Japanese trading companies made a boatload of money in China, PetroChina. I mean, so it's BYD was a $232 million investment that grew to $7 or $8 billion that he's been selling down of late. So to me, it's the decision, having essentially put a stake in the ground and said, not going to sell Apple. It's one of our groves of value. In your 90s, I find myself, and I find most people, as we age, it gets harder to change your mind. Right. And here's a guy at 94 years old, 93, 92, said, I may have put a stake in the ground and told the shareholders that this is likely to be a permanent grove of value.
Mm-hmm.
And he whammed it down by 70%,
Mm-hmm.
by another 60%, at the point where he said he wasn't going to sell it. He changed his mind and said, yep, economically, I've got better things to do with money and I'm willing to pay some taxes here. And so, important, but, and it's contributed to Berkshire's performance, its share price performance, really in the last 3, 4, 5 years, dramatically beating the S&P 500. I mean, you get these guys that come out and say, "Oh my God, Berkshire's been bad for 10 years," or so you had, I don't know, The Economist ran a piece this year and said that this has just been a disaster. It's equaled the market for the S&P 500 for the last 10. And then they said, "Oh, and look at its performance for the last 14 years." They didn't say it was 14 years, but they picked a date. Well, that happened to be only one of 2 time series where Berkshire's underperformed the S&P. I mean, they've crushed it in the last 1 year, 2 years, 3 years, 4 years, because so much of the performance in short-term intervals is driven by what's happened most recently. And because Apple helped the stock, it's beat the S&P in almost every single interval except for 14 years, which was right after the financial crisis.
Mm-hmm.
So there's still a lot of good to be done. And was Apple really important? Yeah. But I don't think it was that much more important than the railroad, Gen Re, because of what it allowed Berkshire to do with the pool of insurance capital. It allowed them to essentially the next year buy MidAmerican Energy. It freed up an overvalued stock portfolio without paying any capital gains taxes to be able to take some of the overvalued capital and even to buy the railroad inside of National Indemnity, which they just spun out to the parents a couple of years ago. But so long-winded answer, but was it great? Yes. Would Berkshire be terrible without it? No. And they would have found they're gonna find things to do with money. They would have found other things to do. Would they have been as good as Apple? But Apple was a big position. I mean, at $36 billion in capital, it was more than 10% of the equity portfolio at cost. So, I mean, he knew he was getting a deal on a business that was trading at 8 or 9 times when you net the cash out of it at that moment. And I don't think he would have expected the thing to trade at 33 or 34 times. I mean, you wouldn't have baked that into the mental gymnastics, but here you find this thing at, high $100 billion position, 30 plus times, going through the very simple back of the envelope math that we walked through earlier. And it had to be sold. So it wasn't just the decision to buy it, but I think what's going to be so beneficial for Berkshire is the degree to which the sale has de-risked Berkshire. A couple of years ago, when Apple was at a high, I was shaving my intrinsic value estimate of the stock portfolio by $50 billion, and that was all attributed to Apple being overvalued. Now, I'm going to shave it, but I'm going to shave a 300 million share position, not a billion share position, which I like the way they're structured late in an economic cycle and having some cash reserves on hand, which, as you and I know, and everybody listening knows, opportunity does knock and it comes around, and just got to have a little bit of patience. But if your job is to write newspaper articles for a living, it's pretty easy to lament the fact that Berkshire's got a lot of cash laying around. Or if you're Mike Saylor the other day, I might have to take to Twitter this weekend, or X this weekend. I mean, saying that Berkshire's cost of capital is 15% and he's destroying money by not owning Bitcoin. And if he could have an hour with Warren, he'd convince him to buy Bitcoin. No, I mean, I think if Warren, I think, called it Bitcoin rat poison. Charlie called it, I think, rat poison squared. I think if you asked Charlie today, Warren wouldn't say this, but Charlie would say, yeah, Mike Saylor is rat poison cubed, because he's out selling shares in at-the-market transactions and in convertible offerings at 3 times the NAV of the underlying Bitcoin and very little value of the core business, which is a crappy kind of a software company. You net out the debt and the cash, and it's 3 times NAV. And Warren would tell you, and Charlie would definitely tell you, absolutely economically smart to sell capital at a very low cost of capital, which when you're at 3 times the NAV of this trading asset that's Bitcoin. But is it immoral? It's reprehensible. The behavior is reprehensible because you're selling shares at such a premium that the new money coming in is the greater fool money. I mean, and So I don't know how I got off on that piece, but
No,
here we are.
you have a good point. I'm just thinking. So first of all, a handful of ideas that played a role in Berkshire. Apple was just one of them. Second point that you made, I really like that you can change your mind, and I think it's very important as an investor that sometimes you have to change your mind. Some of us choose not to share our ideas so that we can change our mind. I think there's some power in the fact that you're not invested publicly in the sense that other people know that you own it and you can change your mind about it, which is harder these days with filings and disclosure, but at least you can change your mind. And the third point is the valuation. It can get to a level where the obvious decision is to maybe shrink the position or move on to something else. I want to ask you about one special early client, an anchor investor, client number one that you write about. And there's a quote in one of your letters. He was one of the greatest unknown investors and among the greatest human beings. And you also share that he pulled off something in 1929 and then in 1932 that will show the audience how this gentleman operated. Can you tell the story of this investor as much as you're willing to share?
Yeah, I wrote about this in, I think, my 21 letter.
Mm-hmm.
Everybody can read it in a section called Benign Neglect, and I can
Mm-hmm.
talk about why I called the section that. Then Jim Grant picked it up, and ultimately, Jim, he and I talked about what you and I are going to talk about here for a few minutes, and right before we went to press, called me and said, the client number one, you never gave me his name, and I said, well, I can't give you his name because he was very private. We're very guarded with our clients. We're not going to talk about him. So I can't do it. And then Jim wrote the thing up and it turned out really well. And I always thought that his story deserved to be told because who he was, not only as an investor, but as a human being. And so I reached out to his daughter and said, hey, look, we just did this interview. I didn't name your dad, but I'd like to take a portion of my letter this year and talk about his life and what he accomplished in the late 1920s and then in 1932, and what we then did in 98, 99, 2000 by pivoting out of a very overvalued stock portfolio, and then kind of tie that into what Warren has done at Berkshire at various secular peaks and troughs. And she endorsed the idea, so I wrote it up. And essentially, very briefly, and not giving it not giving his story enough justice because it should have been a book and could be a book. But told the story of Robert Brookings Smith, our first client. So born in 1903 to a family in St. Louis that was pretty well off. They had a brokerage business that had been around since the 1800s, still exists by name to this day. He goes off to Princeton, plays on the football team. He rows crew, does choir, comes home. His father had passed away and he joins the brokerage business, and really as a mid-20s young novice investor in early 1928 thought that the stock market was becoming a bubble. And so he liquidates the entire family portfolio and had clients that followed his advice and bought a bunch of T-bills and some gilts and some railroad bonds. But essentially sat in cash. We just talked about cash. And if you go back to when he did this, the Dow Jones would have been about 200. And if you know your financial history, the market didn't peak until the fall of 1929, September of 29, at 381 or 384. So almost doubled in a year and a half, a year and 3/4, which to your conversation about clients and having some cash on hand, watching everybody else double their money and money coming into the stock market for the first time in the late 1920s because it was just the thing to do, and a lot of margin debt financing purchases and a lot of wild behavior, speculative behavior. He's sitting there clipping along at whatever it was, 5%. And then vindicated ultimately on what was the 89% decline from 1929 to 1932, which took the Dow from its 380 whatever peak down to 41. And literally at the lows in 1932 buys things like GE for less than the cash in the business. So if you think about the Depression, unemployment went from 5% to almost 25%. Um, if you were doctors, lawyers, and you had patients or clients, a lot of people didn't have money to pay you. You had to live. So even if you had the sense to say, okay, I'm not going to sell stocks at these prices, a lot of people were forced out. You got forced out with your margin loans on the way down, of course. But then a lot got forced out to live, or a lot got forced out psychologically. Like, my God, just lost 90% of my money. Get me out. Because everybody marks whatever their high watermark, their high value, their portfolio to market. So everybody marked their portfolio to 1929, even though your cost basis for most people wouldn't have been an acquisition literally on the day of the peak. Some unfortunate, I'm sure, did, but that'd be a very scant minority. Anyhow, so he buys what essentially Ben Graham was writing about when he was writing security analysis, and Ben lost a bunch of money in that period. Mr. Smith was buying stocks at the lows with these cash reserves, and it was one of the greatest times deployment of cash and short-term holding of cash than has probably ever been pulled off in the history of any capital market anywhere. I mean, I'd suggest that this was one of the most brilliant step-asides and step-back-ends that you could pull off. And then through his investment philosophy of what he'd love to call benign neglect, he rarely sold anything. Kind of a coffee can approach, right? And so, I mean, ultimately he goes off to World War II, volunteers for the war in the late 1930s, calls his friends in the War Department and say, hey, I need to be in the fight. And they said, Bob, we're not going to put you in the fight. I mean, go back to your brokerage business. He said, no. I mean, I've got a patriotic duty to be in the fight. And so they joined the Navy, was in charge of a training vessel on Lake Michigan, and ultimately calls his buddies in the War Department and said, hey, this is great, but this is not the fight. And so said, okay, we'll ship you off. And he wound up in the Pacific Theater, ultimately within a short period of time as second in command on a light carrier, and found himself kind of knee deep in it in the Battle of the Philippines, in the Battle of Leyte Gulf. So when I meet him in 1998, he had pictures in his office of the Japanese Zeros who, in this Battle of Leyte Gulf and the Battle of the Philippines, used their kamikaze strategy for the first time. So when a plane was shot, they would steer for ships. He had pictures of a escort ship sinking right next to their carrier. Men in the water, fire everywhere, plumes of water when torpedoes were hitting the water, and his ship was hit. The hull was damaged. They wind up the Allies, the U.S. Navy winds up winning that Battle of the Philippines, and it was a seminal turning point in the war. But he had to go, but his ship had to go back to San Diego. In any event, a lot of patriotism. His wife was living at the Hotel del Coronado, and famously, she would say, life was pretty good for me. I was at the beach every day looking at the ocean and longing for my Bob, and I'd find myself at the bar every night. In any event, he comes back from war, does not go back into the brokerage business, but joins Mercantile Bank in their trust operation, and over the years becomes the head of the investment operation, and later became vice chairman of the bank holding company. I'm introduced to him in 98 by a mutual friend who had heard me give a speech. And I won't bore you with the whole story of kind of how we got introduced, but it was a fun part of the story, and I think it's in the letter. But he thought there was a bubble, and I thought there was a bubble. And so, as Jim Grant put it in his interview, we joined forces. I love the term. And but instead of doing what he did in 1928, I said, look, under the hood, here's all this value, and you've got this bifurcated market, and you can't go wrong owning some of these smaller cap and mid cap and a couple of Japanese companies. So instead of building up a big cash reserve, we loaded up not a foundation, donated securities to a family foundation, some charitable remainder trusts where you got tax deductions for the gift, partial tax deductions. But I was able to sell all this overvalued stuff. General Electric was half of the stock portfolio
Hmm.
And I thought it was a house of cards. I mean, ultimately it was. 2/3 of the company were the finance businesses that Jack Welch had built up and was running GE to make the quarterly number, was too familiar with the sell side. And when you've got credit businesses and you've got insurance operations and you're trying to make quarterly numbers, that's a bad recipe for
Hmm.
the opposite way to which Berkshire, for example, has run its insurance operations, which is, if business is mispriced, we don't want it. Well, if you're trying to grow the top line and make the quarterly number, you're going to write any piece of business you can, and you're going to perhaps under reserve because you want to show some profitability. And ultimately, all that stuff blew up. Anyhow, was able to sell GE, which even with this run up this year is still down by a whole bunch. We've made 17 times our money on the investments that we made with the proceeds of GE and some of the other stuff that we sold. And so, I mean, his pivot from an investment standpoint, sidestepping the 1929 crash, buying the low, and then literally sidestepping the 2000 secular peak as well, and making a bunch of money at the point where the S&P then dropped 50, and even in the subsequent quarter century is earned 8.2, not what we've done, not what the long-term Ibbotson number has done. So, but the story wouldn't be complete without talking about who he was as a human being. And so I go back to my childhood and the mentors in my life that were my coaches and some of these great men. Well, he's one of the greatest men I'd met, and he just could not have a more kind individual, a more intellectually curious individual. Um, um, we became great friends. He was in his 90s, of course, again, born in 1903. He made it just about the same number of days shy of 100 that Charlie did. Um, and was in the office every day until the last 6 months or so. And so I got to spend, he wanted to spend time with me and I wanted to spend time with him. And so we would spend an hour, hour and a half every single day. Occasionally he'd fall asleep because he was in his 90s and was still playing tennis up until he was 98 and liked to joke that he had to resort to the doubles game because he couldn't cover the court. And then he took a ball in the eye and it messed up his vision, so he had to retire from tennis. But um, uh, he was before the foundation. Was always very generous with his money. Always gave money anonymously to the big charities and not for profits around St. Louis. So through him, I got to meet the directors of the zoo and the botanical garden. Wash U, all kinds of. He was just an incredible human being, and idolized him as a mentor and then as a friend. And he'd tell me, Chris, I'm so thankful for our relationship because here I'm in my late 90s, and if you have the same longevity that I do, you realize all of your friends are going to die before you do. And so he says, I'm thankful for our friendship. And so I don't know. I wrote it up, and his daughter, who had blessed the concept, I sent it to her, and she had just lost her husband, and but I don't know, a month went by and she hadn't gotten back to me, and I thought, oh my God, I didn't do this justice. I overstepped, and ultimately she called me and said, very emotional, this was a really, really nice write up and tribute to Dad. And so I'm glad I told the story because you wouldn't know who he was, but one of the greatest investors extant, but also one of the greatest human beings extant. And I had the privilege of spending 5 or so of his last years with him and learned a heck of a lot.
What an incredible story. I'm glad you retold it here. Just remind me which letter it's in because I've read a bunch of them in the last few days. Was it 2 years ago?
I think it might have been
3 years ago.
Anyhow, the section, so all the letters are on the website. There's a table of contents on the second or third page of each letter. The section is called Benign Neglect.
I highly recommend it for the audience to explore. Benign Neglect. I remember that. I just didn't remember which letter.
I think it was the 21 letter. I think
21.
It was.
That sounds right. What a wonderful story. Chris, I could keep you here all day. I have one last question and I let you fly away. I want to ask you about your definition of success.
Well, you'd probably have to define it in different settings. I mean, I think about family and friends, having a family that loves you and kids that love you as you age, hugely important. Having a group of friends that not only you admire, but that hopefully admire you. Hugely important. Knock wood. I'm blessed on that front, outside of the scourge that I had in my life on that portion of my family. My mother's family, her siblings, she was the oldest of 7. All the remaining 6 are still with us, and they're incredibly wonderful people. I'm blessed to have the wife that I do and the kids that I do. I think from a business standpoint, obviously you'd put up the track record because investing is competitive, and you're waging war against the markets and trying to compound capital without taking risk, and some level beating the S&P. But if you're shepherding client capital and you're doing well and you're not exposing them to a lot of the nonsense and the folly that exists in the casino that becomes the stock market for too much of time. Common thread between the two, Warren was asked at the annual meeting this year, having just lost Charlie. I found it to be a very emotional meeting. And he answered a question about cap-weighted versus equal-weighted S&P 500 and got into codicils of wills and essentially said, you don't want to be John Paul Getty and use codicils in your will to punish your family members, saying, oh, you did this in 30 years ago, remember this is why you're out of the will, or this is why you're not getting as much money as you would get. But then he talks, the very last question of the day was from Paige Spurgeon, and you go back and look at the video, and you want to see it instead of just hear it. But Warren just kind of reflexively went, huh. And the question was along the lines of the will and the last will and testament of Charles T. Munger was published in L.A. County Court, whatever, on such and such a date, and in it contained an initial codicil that essentially said, I'm going to do things unconventionally because wills are typically for the distribution of monetary assets, but I'm going to charge my family with duty to civics and duty to honor and behaving well. And I thought it was just an incredible sentiment. And Warren concluded that thought by saying that the common thread is everybody can be kind. But then he said, and it may have been a different question, but he essentially said, I think it was a question about, could you have been more involved with your kids when they were younger? And it was a terrible question to ask. And he handled it really well and said, no, I look at my relationship with my kids now, and I think it's be a big mistake to say I should have done something differently 30 or 40 years ago. It is what it is. The record is what it is, but I've got the relationship that I do. But then he said, everybody can be kind. But then at a point he said, when it comes to managing money, I like being trusted. He said, Charlie and I like being trusted. And I would tie those two together by saying, I hope throughout my entire lifetime, I find, I like being trusted by my clients and my family, because I didn't trust a portion of the people in my world when I was little, and hope I've constructed my affairs differently to where trust is kind of the thread that ties everything together for me. If that makes sense.
Being trusted. I love it.
Yeah.
I think it's a very powerful aspiration, being trusted. Chris, this was such a wonderful conversation, and we covered so much, and I'm very grateful for the time that we had. I highly recommend all the letters for people that want to explore more and learn more about the way you think and operate. But I want to thank you for today. I really appreciate it.
Well, thanks for having me on. This was a lot of fun and terrific, and I suppose I'll see you at a minimum in Omaha this year.
100%. 100%. Thank you again.
Thanks. Take care.
You were listening to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest subject of all, money. But our conversations lead us to an even bigger question: what it means to live a rich life beyond money. If you enjoyed the show, please take a moment and follow, subscribe, rate, and share with friends and family. We rely on word of mouth to promote the show. One click for you means the world to us. Thank you. Until next time, your host, Bogumil Baranowski.